an 88% gain in 12 months, a 44-year record shattered. Institutional inflows surging 163%, while this extraordinary performance happens in complete silence, and everyone chases yesterday's winners. The mathematics reveal why billionaires call this generational opportunity. Silver obliterated the legendary 1980 peak that financial analysts said would never fall, $56.86 per ounce. While retail investors obsess over artificial intelligence stocks and cryptocurrency rallies, the world's most sophisticated money managers are positioning for what they recognize as a generational wealth transfer that most people haven't figured out yet. But here's what should grab your attention. This isn't just another commodity rally surge. This is the beginning of a structural shift that smart money saw coming years ago, while media attention focused elsewhere. Warren Buffett once said he only swings at fat pitches. And right now, silver is throwing the fattest pitch institutional investors have seen in decades, while Bitcoin dominates headlines and AI stocks capture retail imagination. Net managed money positions have strengthened by 163% since January 2025. Institutional silver-backed exchange-traded products saw net inflows of 95 million ounces in just the first 6 months. That already surpasses the total for all of 2024, pushing global silver holdings in these funds to 1.13 billion ounces, valued at over $40 billion for the first time in history. Yet financial media barely mentions this unprecedented institutional accumulation. The real story isn't just about price movements or institutional flows everyone can see. It's about why the world's most successful investors are betting big. It's about why they're accumulating silver right now, when conventional wisdom says precious metals are old-fashioned relics. The answer lies in perfect storm convergence. Supply constraints, explosive industrial demand, and monetary policy chaos are converging in unprecedented ways, creating asymmetric opportunity. Let me show you exactly what's driving this institutional accumulation, and why missing this could cost you more than you realize over the next 24 months. The silver market has entered what analysts call a structural deficit, meaning demand consistently exceeds supply year after year, with no resolution in sight as industrial consumption accelerates globally. For 5 consecutive years, consumption has outpaced production. In 2025 alone, the deficit is projected to reach 117.6 million ounces of pure shortage. Over the past 4 years, cumulative deficits have totaled 678 million ounces, equivalent to 10 months of global mine production simply vanishing from available supply. This isn't temporary imbalance caused by mine closure or shipping disruption that markets typically absorb. This is fundamental restructuring, driven by forces that aren't going away. Unlike gold, which serves primarily as store of value and financial hedge, silver has become absolutely critical to technologies reshaping our world in ways that mining companies cannot produce fast enough to satisfy. Solar panels, electric vehicles, medical devices, artificial intelligence, data centers, 5G networks, all require silver in massive quantities. Consider the solar energy boom alone as evidence. Silver demand from photovoltaic applications jumped over 25% in 2024, reaching 230 million ounces, with new advanced solar technologies requiring exponentially more. TOPCon panels require up to 50% more silver than traditional systems, as governments worldwide mandate renewable energy transitions. Solar installations are accelerating globally, with no slowdown projected. Industry projections show solar silver demand could exceed 300 million ounces annually by 2030 minimum. But here's where the story gets really interesting for investors. The available inventory of freely traded silver has been dramatically reduced by years of deficit spending from stockpiles. Exchange inventories have been depleted. Government reserves are shrinking fast. Above-ground silver stocks have been steadily consumed to meet industrial demand that cannot wait for new mine production. This creates market dynamics. Investment demand increases trigger disproportionately large price movements. Institutional investors understand this dynamic perfectly, which explains why they're accumulating positions now, before broader markets recognize the mathematical scarcity opportunity. The deficit mathematics are unprecedented. 5 consecutive years of shortage. Global silver consumption has exceeded production for 5 consecutive years, creating cumulative shortages totaling 678 million ounces, equivalent to 10 months of total global mine production vanishing. This isn't cyclical correction. This is structural transformation. The 2025 deficit projection alone reaches 117.6 million ounces of pure shortage between what the world needs and what miners can deliver. But numbers tell only part. Smart money tracks the complete story. The supply side reveals why this deficit cannot be resolved through traditional market mechanisms that typically balance commodity markets. Silver mine production declined 7% since 2016, despite exploding demand. Unlike other commodities where high prices incentivize increased production, silver mining faces unique structural constraints that make supply response nearly impossible. Most silver comes as byproduct: copper, lead, zinc mining operations. Silver production depends heavily on demand for these other base metals, regardless of silver prices, which creates dependency economics. Even dramatic silver price rises cannot increase output. Miners need corresponding base metal demand. When silver prices rise but copper demand stays flat, silver production remains constrained by the primary metal extraction economics. New mine development faces impossible geology. Environmental regulations extend permitting decades. The easy high-grade silver deposits were mined generations ago during previous commodity cycles, leaving only difficult extraction scenarios. Today's operations extract from lower-grade ore. Remote locations, higher costs, greater complexity. Rapid production scaling becomes impossible, even with sustained high prices that would normally incentivize capacity expansion. Mining economics reveal deeper problems. Extraction costs rose 40% since 2020. Only 3 significant new silver projects are currently in development globally, with combined output projections that won't offset demand growth from solar sector alone. Capital expenditure is declining industry-wide. Mining companies prioritize copper, gold projects. Silver mining receives minimal investment because byproduct economics make dedicated silver operations financially unattractive, even at current elevated prices. Mexico supplies 23% of global production. Political instability threatens major operations. Peru accounts for 13% of world output, but faces cartel violence, environmental protests, government policy uncertainty that could disrupt production. China controls processing capacity. Refining bottlenecks compound supply constraints. When primary silver-producing nations face political or operational risks, global supply becomes vulnerable to sudden disruptions. Supply response lag extends far beyond norms. Years pass before new production comes online. This creates opportunity windows for investors who understand resource economics and recognize that current deficits cannot be quickly resolved. Solar energy demand transforms everything. Silver consumption landscape fundamentally altered. Photovoltaic applications jumped over 25% in 2024, reaching 230 million ounces as solar installations accelerate globally with renewable energy transitions. TOPCon panels require 50% more silver. New technology becoming industry standard. Manufacturers compete on efficiency metrics that demand higher silver content per panel, which multiplies total consumption as solar adoption scales. Government mandates drive renewable transitions. Installation acceleration shows no slowdown signs. Industry projections show solar silver demand could exceed 300 million ounces annually by 2030. Creating permanent consumption growth. Industrial users reveal panic through behavior. Tesla secured 12-month forward contracts. BYD paid premiums 18% above spot pricing because CFOs now view silver supply disruption as existential business risk threatening production lines. Solar manufacturers build 6-month inventory buffers. Historical norm was 30-day inventory. Working capital costs have tripled, but companies accept higher financing expenses rather than face supply disruption that could halt manufacturing. Forward contract premiums tell the story. Standard 3-month contracts now cost premiums. 12-month silver contracts trade 15 to 20% above spot pricing, which represents insurance against supply unavailability rather than normal market pricing. Medical device companies joined panic buying. Advanced hospital equipment requires silver components. Healthcare technology advancement increases per unit silver content, while global healthcare infrastructure expands, creating compound demand growth. Electric vehicles multiply silver demand exponentially. Each EV uses 25 to 50 grams, approximately 2 to 3 times more silver than traditional internal combustion engine vehicles for electrical components and battery systems. Global EV production doubling by 2030. Countries ban gasoline vehicles progressively. Automakers pivot entire production lines toward electric platforms that require massive silver consumption for electrical components, battery systems, charging infrastructure. Artificial intelligence creates entirely new demand categories. Data centers require massive silver quantities. AI facilities need silver for electrical systems, cooling infrastructure, high-performance computing components that consume thousands of ounces per facility. Companies race to build AI capabilities. Cloud computing capacity expands rapidly. These data centers proliferate at unprecedented rates, creating permanent industrial demand that didn't exist 5 years ago. Recycling cannot fill the gap. Silver recycling recovers only 15% annually. Industrial silver consumption represents permanent loss from available supply, because electronics recycling proves technically difficult and economically unviable. Recovery rates decline with new technologies. Modern electronics use smaller silver quantities. Extraction becomes cost prohibitive, which means most industrial silver consumption removes metal permanently from circulation. Substitute research reveals desperation across industries. Companies spend millions developing alternatives. Copper paste research fails efficiency requirements consistently, because silver's unique electrical and thermal conductivity properties cannot be replicated. Aluminum alternatives hit physics limitations. Patents filed shows zero viable commercialization. The fact that major manufacturers invest heavily in substitute research while continuing to secure silver supplies reveals their assessment of future availability. Meanwhile, available inventory tells alarming story. COMEX registered silver dropped from 120 million ounces, now below 80 million ounces. London precious metals vaults showing stress, with delivery delays extending beyond normal settlement periods, which historically indicated physical shortage. Shanghai premiums spiking above London pricing. ETF inventory levels versus paper claims create mismatch. When exchange-traded funds cannot source physical silver to back new share creation, paper markets disconnect from physical reality. Mining reality tells opposite story. Production capacity cannot expand quickly. The mathematical impossibility becomes clear when you map projected demand growth against realistic production capacity expansion timelines. Demand grows exponentially across multiple sectors. Supply grows incrementally, if at all. The gap widens every year, creating structural scarcity that markets have not fully recognized or priced into current silver valuations. Billionaire positioning reveals everything you need to understand. A Texas-based billionaire recently made headlines. She purchased massive quantities of silver eagles through precious metals dealer Andy Schmann, with plans to buy significantly more. This follows institutional patterns. Ultra-high net worth individuals quietly build positions. This pattern has emerged across precious metals markets over the past several years, as smart money recognizes genuine scarcity combined with utility. Most assets that appear scarce face artificial constraints. Regulation, technology, or market manipulation limit availability. Silver's scarcity is physical and mathematical because there's finite amounts in the ground, while extraction becomes increasingly difficult. Industrial consumption accelerates due to technological trends. These trends show no signs of slowing. This creates what professional investors call asymmetric risk-reward profiles, where downside stays limited while upside potential becomes explosive. Industrial demand provides price floor protection. Investment demand could overwhelm constrained supply. When institutional capital decides to chase performance in precious metals, available silver for purchase becomes extremely limited very quickly. Professional money managers understand another critical factor. Retail investors typically miss this completely. Silver's price suppression through decades of derivative trading has created artificial pricing that bears little relationship to physical reality. Paper silver contracts trade in volumes. Trading dwarfs actual silver production enormously. This financial engineering has kept prices artificially depressed compared to underlying supply and demand fundamentals that would typically drive prices higher. But derivative markets work both ways. Physical shortages become apparent when users compete. The paper trading complex can unwind violently as futures contracts require settlement, and industrial users demand actual delivery. Exchange-traded funds need physical silver backing. Industrial users require actual metal delivery. This convergence between paper and physical markets has historically produced some of commodity history's most dramatic price movements. The silver market's relatively small size amplifies dynamics. Entire annual silver mine production worth roughly $30 billion. That's less than market capitalization of many individual technology companies, which means institutional capital allocation can move entire markets. A single large pension fund deployment moves markets. Sovereign wealth fund positioning affects global pricing. Smart money recognizes these mechanics and positions accordingly during quiet periods when prices reflect oversupply concerns. They accumulate gradually to avoid moving markets. Most importantly, they hold through volatility. They understand long-term structural forces driving demand higher, while supply constraints prevent traditional market rebalancing mechanisms. Current accumulation phase shows institutional positioning hallmarks. Trading volumes have increased substantially, even as prices rose. This indicates genuine demand rather than speculative momentum that typically characterizes retail-driven rallies in commodity markets. Large block transactions become more frequent. This suggests institutional rather than retail buying. Most tellingly, futures market structure has shifted toward backwardation, where near-term prices exceed longer-term prices, indicating physical demand urgency. This technical setup historically precedes significant advances. Physical demand creates immediate delivery scarcity. Longer-term contracts remain cheaper, signaling that markets expect current tightness to resolve through higher prices rather than increased production. Professional traders recognize this pattern. They position accordingly for price acceleration. The geopolitical dimension adds another urgency layer to silver accumulation, as trade tensions highlight supply chain vulnerabilities. Silver's importance to defense technologies becomes strategic. Renewable energy infrastructure requires massive quantities. Advanced manufacturing makes it strategically significant beyond investment characteristics alone, which drives government and corporate strategic reserve building. Countries build strategic reserves, ensuring access. Corporations prioritize supply security over cost optimization. This strategic hoarding behavior further reduces silver available for open market trading, as these reserves don't return during price spikes. Strategic reserves represent permanent demand destruction. Available pool for other users shrinks. The acceleration of these trends in 2025 suggests we're approaching an inflection point where multiple demand sources converge simultaneously. Industrial demand continues growing faster than production. Investment demand awakens as institutional allocators recognize opportunity. Strategic demand from governments and corporations adds permanent buying pressure that removes silver from circulation indefinitely. Available inventory continues shrinking as deficits persist. This convergence creates what analysts call supply shock setups. When demand from multiple sources simultaneously increases while supply remains constrained, prices don't adjust gradually like normal market mechanics. They spike violently as buyers compete. Limited availability forces panic buying. Silver market characteristics make it particularly susceptible to this type of price disruption, because small market size amplifies capital flow impact. The timing couldn't be more crucial for positioning. Most analysts project silver prices climbing between $61 and $81. By the end of 2026, with longer-term forecasts reaching $133 to $143 by 2030, based on structural demand growth. But these projections assume orderly conditions. They assume gradual investment adoption. What they don't account for is what happens when retail investors finally wake up to what billionaires already recognize. When investment crowds discover assets in genuine scarcity, explosive fundamentals don't create gradual price rises. They gap higher violently as buyers chase limited supply, which creates momentum that feeds on itself until scarcity becomes obvious. The monetary backdrop makes this scenario probable. Central banks worldwide printed unprecedented currency amounts. The Federal Reserve's balance sheet remains near historic highs despite reduction attempts, while European central banks continue quantitative easing policies. China's monetary expansion combats economic slowdown. Billions more flow to global liquidity. This ocean of newly created money needs investment destinations, and assets with genuine scarcity become magnets for capital seeking inflation protection. Silver offers something unique in this environment. Unlike stocks, bonds, or real estate options, you cannot print more silver, which differentiates it from financial assets that can be created electronically. Unlike cryptocurrencies, you cannot fork blockchain. You cannot create competing tokens. Unlike commodities that can be substituted, silver's industrial applications often require its specific physical properties for electrical conductivity. This combination of monetary inflation and physical scarcity creates conditions. Prices can move exponentially rather than incrementally. Professional money managers understand that silver's market dynamics create leverage to monetary policy that most investors haven't recognized. Central bank policies create currency debasement. Physical assets benefit disproportionately from purchasing power. Silver combines inflation hedge characteristics with supply scarcity that multiplies policy impact beyond other precious metals or commodities. The convergence timing appears critical. Institutional capital allocation shifts are accelerating. Pension funds, insurance companies, sovereign wealth funds are beginning precious metals allocations that historically remained minimal. Even small percentage allocations create massive demand. Global pension fund assets exceed $50 trillion. 1% allocation to silver would require $500 billion in purchases against annual mine production worth only $30 billion. Insurance company reserves approach similar magnitudes. Sovereign wealth funds control trillions more. When these institutions recognize silver's asymmetric opportunity and begin allocation shifts, available supply gets absorbed rapidly. The accumulation pattern reveals itself through professional behavior. Institutional buyers accumulate during quiet periods. They build positions gradually before retail recognition. They understand that once trends become obvious to everyone, accumulation phases end and opportunity windows close. Supply constraints mean late buyers pay premium prices. Early positioning captures maximum upside potential. The mathematics are becoming undeniable as deficit years accumulate, while demand growth accelerates across multiple industrial sectors simultaneously. Mining supply response cannot match demand trajectory. Political risks threaten major producing regions. Recycling cannot fill growing gaps in available metal supply, while substitute research fails to produce viable alternatives. Professional investors recognize these converging factors. They position accordingly, while prices reflect oversupply. The window for accumulation ahead of broader market recognition may be closing faster than most investors realize. The question facing investors isn't whether silver prices will rise substantially. The mathematics make that virtually certain. The question is whether you'll recognize this opportunity before prices gap higher beyond comfortable entry points. Billionaires accumulate now because they understand something. Once trends become obvious to everyone else, the opportunity to buy at reasonable prices disappears quickly as supply shock dynamics create violent price movements rather than gradual adjustments. History shows that commodity supercycles build quietly. Smart money accumulates during structural shifts. Then they explode into public consciousness when scarcity becomes undeniable to retail investors who chase performance after major moves. Silver appears to be following this exact pattern. Institutional accumulation is accelerating precisely as structural deficits reach critical levels. The window for positioning ahead of the crowd may be closing faster than most investors realize. The pattern couldn't be clearer if announced with neon signs. Billionaires aren't accumulating silver because they enjoy collecting shiny metals. They're positioning for what they see as inevitable mathematical outcomes when supply deficits persist for 5 consecutive years. Industrial demand accelerates exponentially across multiple sectors. Available inventory shrinks year after year. Only one result becomes possible when these forces converge simultaneously. Most analysts project silver climbing to $61 to $81 by 2026. Longer-term forecasts reach $133 to $143 by 2030. But these projections assume orderly market conditions and gradual investment adoption that may not materialize given current dynamics. Gap higher scenarios become probable. Violent price movements replace gradual increases. When physical shortages force paper market convergence, prices can move exponentially rather than incrementally. The timing becomes critical for wealth preservation. Central bank monetary policies continue currency debasement. Physical assets with genuine scarcity become magnets for capital-seeking purchasing power protection against systematic currency depreciation. Silver offers unique positioning in this environment. Cannot be printed, forked, or substituted. Industrial applications require its specific physical properties that alternatives cannot replicate, despite millions invested in substitute research. Professional money managers position early and quietly. They accumulate during structural shifts before retail investors recognize opportunities. They understand that by the time financial media reports silver shortages and price spikes, the easy money has already been captured. Right now, while debates focus on artificial intelligence stocks, cryptocurrency prices dominate headlines and capture retail attention. The world's most successful investors are building positions in an asset offering genuine scarcity in an inflated world. The mathematics remain simple and undeniable. 5 consecutive years of supply deficits. Industrial demand growing exponentially across solar, electric vehicles, artificial intelligence infrastructure, mining production declining despite higher prices, because byproduct economics prevent supply response. Available inventory shrinking as strategic reserves remove metal permanently from circulation. The opportunity appears clear to those analyzing fundamentals. Supply and demand imbalances of this magnitude historically resolve through dramatic price adjustments rather than gradual market rebalancing. The timing is now for positioning before broader market recognition makes accumulation expensive. Whether you join billionaires in recognizing this asymmetric bet depends entirely on your assessment. Watch from sidelines as prices gap beyond comfortable entry points. That choice remains entirely yours to make. But remember something about supply shocks and commodity cycles that history teaches consistently. Once supply shocks become headlines reported across financial media, the accumulation phase ends permanently. And once these phases end in commodity markets, they don't return for decades. The mathematics were always there for anyone willing to analyze supply and demand fundamentals objectively. The opportunity was always visible to those tracking industrial consumption growth against mining production constraints. The only question was whether you'd recognize the convergence before the silence ended and everyone else discovered what smart money already knew. The window is closing. The mathematics remain clear. The opportunity waits for no one.